last week. We talked about things that we might do. We talked about current market conditions, how I had put together two presentations. Hey, if the market shuts down, here's some of the things that you're going to want to consider. I was building these webinars on Tuesday, I had them ready for Tuesday, a week and a half ago, when they were talking about the government shutdown. We're talking about the vote and everything along those lines. Say, hey, look, if they shut down, here's what to expect. And we're seeing the sell warnings on the market sentiment tool on PowerOptions. Still in the sell warning area, but the sell warnings really started back on September 22nd, 23rd. So 19th, 22nd was the big day. 6 bearish signals of the 13 market sentiment warnings, 7 neutral, no bullish. And then it dropped back down to 4 and 9, but it stayed at 4 and 9. But 922 was really the high point here, where normally I would have expected to see a strong bearish sell warning. But last week, on October 3rd, we talked about how the market conditions and different paths we're going to be using. We talked about bear put debit spreads, VIX calls, calendar put spreads, if the shutdown extends longer term. All right. And why is that important? Let's go to our portfolios again. And instead of radioactive trading 2024, let's go to October 6th on Monday. With the VIX, I know it had a big jump today. It was waffling around at it went up to about 1734 on Wednesday and on Thursday. And then it pulled back down to the Tuesday and Wednesday, and it pulled back down to the 16 range yesterday when there's a little clawback. And then, as Kit mentioned, well, this was a fun day. Yeah, we had some hesitation in the early morning. Looked like things were trying to fight, and then the events happened that blam, here we are. On Monday, the VIX was at about 1673. Let's see what we did here. I want to go to edit position. I'm going to go to position actions. I was right. Edit position. It was at 1637, waffling in that area, 1615 to 1630. Using a long call VIX search that we have, I would have bought the 19th November 2450 call. Now, trade balance, you've heard me talk about this before. We'll look back in the portfolio in just a moment. But I would have bought 8 contracts at about $1.28. Normally, I would have gone further out of the money, actually, to the 25.50 or the 26, where the price was less than $1, and just put about $800 into VIX calls at that point. Also, this position, to be honest with you, on Wednesday, when the VIX went up to about 1760, 1777, was it Wednesday, I think? We'll take a look. I would have closed half of these for a profit, not the profit it is now. But at today's close, VIX calls discussion from last week, it's a 62% gain in a 4-day period. The bear put debit spreads that we discussed, using the at the money bear put debit spread screen on Monday, would have found these bear put debit spreads, AEO, CPB, ENPH. Stocks were at different prices at those times, but right now the liquidation gain or loss on AEO is 25%, and almost 22% on the CPB position, Campbell's Soup. Moves slower, less volatility, and a 59% gain right now on ENPH. Now, this CPB one is further out in time. It's in November, but the ones that came up were for the 17th of October. We've been in them for 7 days. At the money, bear put debit spreads. This one actually would have been closed yesterday or earlier today. With the discussion, we talked about hitting the 50% of your expected return. Of course, if we hold it for the next 7 days and it stays where it is, we're going to make 92% of what the max return we expected to make. What were these per our discussion? These were sort of out of the money bear put debit spreads. Well, let's take that ENPH position, not because it's the highest gain, but well, because it is the highest gain. And I'm going to go to edit position once more on the portfolio here. And what we could have done is bought NPH 17th of October 38 put. So we're buying a higher strike put, and it would have cost us 236. The October 36 put on 10/6 we could have gotten for around 132, and this was when the stock was at 37.16. So the stock was trading right about here, right between the two strike prices. Now it's taking a little bit of chance with these at or out of the money bear put debit spreads in this case. Why do I say that? Remember, we did buy the 38 put, which gives us the right to force someone to buy our shares of stock that we don't own, or cover the 36 put if we're assigned at any time. Now, the 36 put was out of the money at the time, so there's no threat of that. But now the stock has fallen, I do have an obligation to potentially deliver shares of stock that I don't own of ENPH, but because I have the deeper in the money put, my broker would exercise the put to cover the short obligation. I'd get $2 back on a net debit of 104. But let's go back to the portfolio. Let's go back to ENPH. Let's take a look at that profit and loss chart. And as we discussed, this was the position that was entered. But remember, it was entered. I want to use a different color. I don't want to use black. I want to use something that stands out. Let's use this neon or bright green. Okay, let's go ahead and do that. But remember, the position was entered. We're selling the 36 put here. That's our pivot, in a sense. And we bought our 38 put. And this was done when the stock was in this range, when it was right about break even. Now, we did 5 contracts of this position. I'll talk about that in a moment too. But let's just say we did 1 and 1 to keep the math simple. This is what we sort of talked about, this at the money bear put debit spread. I paid a price of 104 to enter the debit. I paid more for the in the money 38 put bearish strategy. You could have done this with a bear call, but you would have used different strikes most likely. You wouldn't have sold the in the money 36 call, the stock at 37. You might have sold the 38 and bought the 40 in that case, because you don't want to risk early assignment. But on the bear put debit spread or a bull call debit spread, if you're in a bullish zone, you don't have to worry about that. But anyway, total net debit of 104 on a strike difference of 2. That means if everything works out as expected, the stock remains below 36 next week. What happens? We get $2 back at full expiration at maximum profit, make a $96 profit on an investment of 104. But like I said, this position would have likely been closed when we hit 50% of the maximum profit as well. Now, do I do this? Excuse me. Do I do these bearish put verticals, these at the money bearish put spreads on a regular basis? No. Normally, I'm doing our preferred weekly picks of the day in the bull put credit spread. But when I see the market sentiment change into those sell warnings, as we talked last week, that's why I start lightening up on the bull put credit spreads, closing out some of the ones early for a profit, and then moving into a new strategy. Now, what we just showed in the portfolio is what is possible about what we talked about last week. On October 3rd, on Friday, let me go back here, the 2 webinars we posted, of course. Thoughts on, first one initially, Rant and Rave, thoughts on current market and economy, trade ideas moving forward, Rant and Rave and Ramble Part 2, flags allocation, calendar put spreads and review. I didn't open any calendar put spreads as discussed in this presentation. These were what we would have seen for positions we would have opened in that discussion with the VIX calls and with the bear put debit spreads directly from the sample search view under bear put debit spreads as illustrated in that previous webinar. I didn't open in calendar put spreads because I'm still concerned about how far the drop may continue. That's alluded to. These are the bear put credit spreads that could have been opened and VIX calls that sort of were opened. But I didn't open any of these specific bear put debits, but take a look here. We talked about splitting out 50% of what we were doing in bull put credit spreads. to go through to the application of closing those positions, which are mostly closed now, by the way, and allocating that into this new pattern now that we're seeing these positions. I put in a basis date of 9/22. That was inaccurate. It should have been 10/6. But you're looking at a 31.1% return in 4 days. What did I actually do? What I actually did, the positions I actually switched over. Why can't I find it now? It's labeled differently. I apologize, folks. Oh, did it not save? Or did I label it wrong? I must have labeled it wrong. It wasn't August 22nd. It wasn't September 20. Oh, there it is. September. Sorry, folks. September 22nd. All of them are looking familiar to me. On September 22nd, as I mentioned, when we saw the bearish sell warning signals, these were the bear put debits I went into. A Lulu position. When the stock was around 171, 172, we sold the 170 put and bought the 175 for November 21st expiration. Allocation here was about $4,800. So with a 5-point spread, net debit of around $350, we just did about 5 contracts. We did 6 contracts on the 2-point spread, 7 contracts on the 2.5-point spread. And again, we see these positions now today with the big drop, but the original expected return and what we're looking at, the current liquidation return, 36% here on Lulu, 86% gain on Siri, and on the Whirlpool one, 44%. So again, about a 30.4% return in 18 days. When we're seeing the sell warnings, converting some of our bullish trades, and this still, in addition, the vertical spreads only will ever represent about 12 to 15% of my total portfolio. We're taking half of that down now, 6 or 7%, as discussed from last week's presentations, to say, oh, the sell warnings are coming up. I'm going to take my good winners off the table, maybe manage these other bullish trades. Now I'm looking at these bear puts. Let's take the capital there. Let's apply it here because I'm seeing the sell warnings and I believe it. By the way, these are the positions that I did, excuse me. But the Whirlpool position was actually closed 2 days ago because it hit a 60% profit. And as we discussed, these at the money debit spreads, as we saw with the previous position, that we could have opened on October 6th. But this position from September 22nd, the high point profit, believe it or not, was here. When it was in this decay, the volatility was increasing, and this was the best time to exit the position, which was only about 8 or 9 days into the trade. Now, as you can see, we're still seeing a profit here, but the bid-ask spreads have gotten so wide with the news today, the fall today, that it's not showing us, it's still showing us that high profit. Don't get me wrong. We're still at, what was it, 67? Oh, 44%. Well, we got out about a 51% return on the Whirlpool position. Closed it at that time. And because the idea of these positions, when we see the bearish sell warnings come up, getting close to a 1-to-1 risk-reward ratio. This one was perfectly even, by the way. Very fortunate. Let's go just one contract to one contract to keep the math simple rather than using the allocation. So on that initial net debit, we would have had, come on, Mike, get it together. 1 and 1. Initial net debit we would have had of 125 for this 2.5-point spread means we could make 100% return on what we invested on this position in a shortened time period. It's about 31 days. No, 31 days. 18 days, 19 days, if I'm not mistaken, from September 22nd till the standard October expiration. But the idea here is if you make half of what you expected to make on this trade, you take it off the table, and that's what we did. We got our $62, $61 profit with the max profit at 125 and closed the trade out early. But the allocation, remember, if we're putting in about 4,500, 4,600, net debit of 125, we did 7 contracts. Now remember that 4,500, 4,800 we're talking about is only half of the 12 or 15% that we would normally invest in debit spreads. It's about 6, 7%. So 875 of the 4,800. I could have gone close to double this, right? I could have gone in 12 contracts, but I wanted to be at just half because I'm not sure, not certain. This one did hit the profit target before today's movement. The other two were at a profit, 8%, 12%, 20% earlier this week. Now, of course, Siri is hit that point. I didn't close it. This one might be closed on Monday, but this other one here, the Lulu one, I think maybe flirted with the 50% profit, but didn't hit it. One of the reasons why is that these two, as you can tell, the Siri position and the Whirlpool position are closer expiration. Lulu is further out in time. It's the 21st of November, so I'm not quite reaching the time value decay I need on these positions. And with the volatility increase, it's helping the gain on my long put, of course, the 175 put on Lulu, but the short put is also being affected, that 170. So I'm not quite at 50% profit on this Bear Put Debit spread. But once again, days in the trade, 18, 7 days to expiration. Oh, this is the wrong option, isn't it? No, it's the right option. I put in the wrong entry date. Sorry, I put in the wrong entry date in our webinar portfolio. This was 9/22. This was the actual trade at 85 cents. 215 for the long on Siri, 85 cents for the short, debit of 130 on a 2-point difference. So the maximum return, of course, was only about 54% instead of 100% or 127% with the fills that we got. But in any case, this one still has time. And so I need more of the time decay. However, if Monday we see a shift and the market starts to move up, then maybe I will close this for 35, 36, hopefully 38, 40% profit on the position. But again, 18 days, 30.4% profit. What we could have done on Monday with a smaller portion of our portfolio, because we don't know, 31.1% in 4.5 days, 4 days, 3.5 days, I meant to say, sorry, 4 days, folks. But some of these, as you see, still have longer term to expiration. And again, the Bear Put debits that we used were based, oh, sorry about that, folks. I went to search by symbol. The Bear Put debits we were talking about for the previous discussion, if I go to sample searches and I look at out of the money, out in time Bear Put debit spreads, this isn't the direct search. Some of these are further out in time, but as he showed last week, we have a different search that, look, a little customized search that we like to use here. So we're at out in time debit spreads. Yeah, these are the sort of the 70, 98, 133s. And yeah, that's essentially, but we took the shorter term in this case. And there's Lulu again, still in there's a potential Bear Put debit 70 days out. GME, GameStop's in there. That's pretty interesting. I haven't seen what they've been doing. That's just so embarrassing. I hate when that happens, right? You show someone what stocks would come up in a bearish search for the bearish criteria that you use, and it happens to be one of the married put positions you're holding long term with still 60 days to go, 70 days to go to January expiration. But there's Kraft Heinz, a potential for a Bear Put debit spread with everything that's been going on here. And as I mentioned, we're talking about some of these 68, 78, 94% returns. We're not looking to make that full return. We want to close it when we hit 50% of the maximum profit on the trade. So I'm not saying, of course, that every week, every 10 days, every 17 days, every 25 days, you can expect to make 30 to 30% returns with the vertical spreads. What I am saying is that the concepts and ideas that we apply, that you hear me talk about when we see the sell warnings, when I'm moving from a bullish strategy to a bearish strategy, and why? Why am I looking at potential VIX calls as a long-term, not a long-term, but a shorter-term market hedge when we see those sell warnings come up?